Here, the calculator too. Okay, so what the calculation would be simply for the current assets, we take 234, put it in our calculator, minus 180 equals 54, the difference, and we divide by the 180. And we get 30%, which is shown down here. So let's try some other examples. So again, it's base year is the first year. Current year is the year that you're analyzing. And it's simply current year minus base year divided by base year. So for accounts receivable, it would be 460 in this example, minus 400, 460, minus 400, divided by 400. And we'd say that accounts receivable increased by 15%. Now, yes, there are other ways to do this. I'm giving you what I think is the simplest way. But just like almost any mathematical exercise, there are probably 100 ways to do it. So inventory, 780 in the current year, 650 in the base year, means it increased by 130,000. Of course, you can do that math in your head. And you divide by base year. So we say that inventory grew at 20%. The reason we know it grew is because the current year is larger than the base year. Current year is larger than the base year. And the last one, total assets, 316,164,000 minus 2 equals 360,000 divided by 2,000,000. We would say that total assets increased by 13%. So far, so good. It's pretty cake. So one more example from your book, your textbook, brief exercise 13-4 on page 1339. This is the exercise. The top part is what you're given. The bottom part is what you need to calculate. It's simply base year. Current year minus base year is the top part. So this 60,000 is a result of 400,000. 460 minus 400,000 gives you 60,000. And the 400,000 comes from the base year, 400,000. And that gives you an increase of 15%. Second one, inventory is 780 this year, was 650. That's an increase of 130. That's where the 130 comes from. And simply the base is 650, and you have an increase of 20%. And finally, you have 3164 minus 2800 gives you 364,000 divided by the base year, 2,800,000 gives you an increase of 0.13% or 13%. So when we ask for a schedule of horizontal analysis, we're simply asking for this. But what you would do is if you're using Excel and you're given this, you simply add 2 columns, one that increases the amount, one that increases the percentage. If you know how to do that in Excel using the formula, that's awesome. Recommend you learn. If you have to do it by hand, then you have to do it by hand. But all you're doing is the same function. 48,000 comes from the 80,000 minus the 128,000 or the 128,000 minus the 80,000, and then you divide the 48,000 by the 80,000. So far, okay? Like I said, this is kind of easy. Okay, can everybody see the new slides up? Okay. So we'll continue the discussion on horizontal analysis started last lecture. Horizontal analysis is the technique for evaluating a series of financial statement data over time. It's basically all I want you to know is it's an analytical tool. Purpose is to determine the increase or decrease as a percentage over time, and the increase or decrease can be expressed as an amount or a percentage. Usually I used percentages. The horizontal analysis is performed both on the income statement and the balance sheet, which is something we haven't done yet on the income statement. There are currently two ways to perform the calculation. And we'll go into that. Caution, when using horizontal analysis, if an item has no value in a base year or preceding year, I'm calling that the current year, a value in the next year, no percentage change can be computed. If you have zeros, you can't do it because you're going to get the infinity mark in your calculator. And if a negative amount appears in the base or preceding year, then also you're going to have a problem doing this. Again, same formula. Change since base year equals current year amount minus base year divided by base year. So now we're going to use an income statement item called revenue or sales. And we're also going to introduce the concept of doing a current year that's not the next year. So in this case, we want to analyze the change between 2018 and 2022. So 2022 would now be the current year. Any year that I want to do in those 4 years would be the current year. So if I was doing 2021, that would be the current year. Or if I was doing 2020, that would be the current year. If I wanted separate percentages for each year, I do the calculation 3 times. First time using 2020 as the current year, the second time using 2021 as the current year, and the third time using 2022 as the current year. The 2018 would always be the base year because that's the first year given. Okay, so you can see page 1310 of your textbook to get the information that I'm using. I just recreated that, the example from your book. The formula stays the same. Calculate the change in net sales from the base year to 2019 in terms of both percentage and amount. So this time we're using 2019 as the current year. Current year is 9614. The base year is 8812, which is this number, and the difference is the change in amount. The percentage change will be the 9614 minus the 8812 divided by the base year. So that would be 961. I have the calculator showing up. Does everybody see that? minus 882 equals a difference of 802 divided by the base year of 8820. And it's a 9% change. So we can also do net sales. We can do it on any element of either the balance sheet or income statement. Meaning, what I mean by element, I mean assets. We could do it on total liabilities. We could do it on stockholders' equity. We could do it on revenues. We could do it on expenses. We can do it on net profit. We could also do individual items. For example, cash, accounts receivable on the balance sheet, inventory, current liability. We can do it on accounts payable, current liabilities. On the income statement, we can do it in revenue, operating expenses, rent, anything we want to do. In this case, we're doing it on net sales. So 2022 would be done the same way. The current year is now 2022. The 11 million, and you use the 11,776,000. Subtract that from the base year, 8812, and come up with an increase of 2,964,000 in terms of an amount. So we would say that net sales changed from 2000, increased from 2018 to 2022 by 2,964,000. We could also say, do the same thing with the percentage. 11 million, again, 2022 is the base year, is the current year, and 8812,000 is the base year. 2018 is the base year. Current year minus base year, which is increase, divided by base year. So the percentage change would be 33%. So 11,776,000 minus divided by 80 gives you approximately a 33% increase. So we would say that net sales increased 33% between 2018 and 2022. Pretty simple. So simple, you're probably going to sleep. Another example, sales. Again, 2018, in every situation, the first year given is the base year. Regardless of the information given, whatever the first year is, that's the base year. And you would calculate the base, same example. So if you're doing 2022, base year would be 2018, and you use those numbers and divide. And in this case, net sales increased by 133%. And it's called horizontal because you're going horizontal. One more time. Do it, number 2. Here's the same information again. Here we're doing balance sheet analysis on Central Chicago serial. And it's the same process. We want to do current assets. $2,717 minus 2,427 equals 290. 290 divided by 2,427 would be it as a percentage. Percentage would be 11.9%. You could also perform horizontal, as I said, you can perform horizontal analysis on broad balance sheet concepts, current assets, plan assets, other assets, total assets, blah, 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 or individual accounts like net sales, cost of goods sold. You can do it also on the balance sheet. So for example, I did selling and administrative expenses. So selling and administrative expenses for the base year was $3,559,000. And for 2022, it was $3,311,000. The amount it went up was $252,000. Percentage is 8.02%. Everybody okay? Okay, vertical analysis. Is kind of the same thing, except you're doing it vertically. And you're also doing what's called common size analysis, which we'll talk about in a second. Common size analysis simply means that if you're trying to compare two different companies, you want to make them the size equal as a percentage. So vertical analysis just means you're going down. It's very similar in that respect. It's very similar to horizontal analysis, which you're going across. But Vertical analysis is mostly used when you want to compare two companies. For example, as you see here. So I have Chicago Cereal and I have Giant Mills, two probably competitors. Can I see that? So I have two competitors and I'm an investor and I want to see which company I want to invest in or which company did better. And what I'm doing here is I'm essentially breaking it down in percentages so I can analyze in terms of apples to apples. So sales, regardless of them being, regardless of the size difference here, one company had $11 million, 1 billion, one company had $17 million. That's a kind of a big difference. It's still 100% of what they got. So you'll, in vertical analysis, when you're doing two companies, you'll always set the sales to 100% for each company. Even though 11 million doesn't equal 17 million, each one is set to 100%.
Do we just automatically set it to 100%?
Yes.
Okay.
And that's the benefit. That's really the only use of vertical analysis that I did. I never did vertical analysis on the same company. I usually just did a horizontal analysis across. And as you can see, it really doesn't make a difference when you're doing the same company. It does make a difference when you're doing different companies because you want to set them both to 100. You want to compare apples to apples. Now, this 56% simply comes from dividing 6,597 by the 11,776. So what you're doing is you're taking its sales, Chicago Cereal sales, and dividing by its cost of goods sold to get a percentage of cost of goods sold. I've done nothing with Giant so far. So all I'm doing is saying, okay, Chicago Cereal had a cost of goods sold percentage of 56%. Now I'm going to determine what Giant's cost of goods sold is in the same way. I'm going to take its cost of goods sold and divide it by its sale. And I'm going to get 64%. So what that means is that Chicago Cereal, it costs them 56 cents on every dollar to produce the product. Every dollar worth of revenue, it costs them 56 cents to generate every dollar worth of revenue. For Giant Mills, it costs 64 cents for every dollar of revenue. So you're comparing apples to apples. You're comparing the cost of generating revenue in this case. And that's what we mean by common size. We're making both of them the same. So we would say, based on so far on the analysis, we would say that Chicago Cereal is better operated than Giant Mills, even though Giant Mills has $6 million more worth of sales. They're only generating 64 cents they're only generating 34 cents or 35 cents of every dollar to revenue, profit. Whereas Chicago Cereal is generating 44 cents. And I'll show you where I got that. So the difference between 100 and 56 is the 44. 100 is everything. 56 is the cost. So the profit is 44. In Giant Mills case, again, 100, but the cost is 64. So the profit is the difference of 35. What I'm saying is 44 cents of every dollar that Chicago Cereal generates of revenue is going to profits, gross profits, as opposed to 35.6 cents of every dollar that Giant Mills of revenue Giant Mills produces goes to gross profit. So we're reducing it to a percentage. It's basically what they call common size analysis. And we're comparing the percentages. Selling and general administrative. Again, we do the same thing. 3,311 divided by the entire amount of sales, 11,776, is how they got to 28.1%. So they took just the information for Chicago sales, the selling and general administrative expenses, and divided by the net sales to get the percentage applicable for Chicago cereal. They do the same thing for Giant Mills. 3,474 divided by 17,910. And that's how we get the 19.4%. So the trick here is to remember to use only that company information and then reduce it to a percentage and then compare the percentages. So in this case, Chicago Cereal has a much higher percentage of selling and administrative expenses than Giant Mills, 28.1 to 19.4. That tells me that 28 cents of every dollar that's generated from revenue goes to paying off selling and administrative expenses for Chicago Cereal. This also tells me that 19.4 cents of every dollar of revenue generated by Giant Mills goes to selling and administrative expenses. So in this case, Giant Mills is better, which is a smaller percentage, 19.4 to 28.1. So the cost of generating the product, so what that means is Chicago Cereal manufactures the product more efficiently, but Giant Mills operates its administrative and selling department more efficiently. So now it comes, which one do you care about more? And that's kind of what we're going to be talking about in this class. The importance of each one of those, the importance of cost of goods sold, and the importance of other administrative expenses. I'm going to ignore non-reoccurring items because, again, that's outside of sustainable income. And we're going to take income from operations. Okay, so to get that percentage, we take the 1868 divided by the 11,776, and we get 15.9%. So we took this number, divided by this number to get this number. Now, as you can see, this is a running total, just like the income statement we did in 260. We start with net sales, which is 100%. We take off the cost, we have a remainder. We then will take off selling administrative, and we have a remainder. Same thing with Giant Mills. We start off with 17,910, which is 100%, and we take off the cost of goods sold, and we have a remainder. 6,370 plus 11,4. So if you add 6,370 to the 11,540, you're going to get the 17,910. And subsequently, if you add the 5,179 to the 6,597, you're going to get 11,776. So all we're doing is essentially adding down while subtracting out different components. Now we take the 6,370 and subtract 3,474 from it, and we get 2,958 minus the 6. And in this case, we take the 5,179, subtract the 3,311, and get 1,868. So far, okay? And to get this percentage, we simply take the 2,958 and divide it by the 17,910, you get 16.5. So that's telling us, and we'll learn this a little later, we'll talk about this more a little later, is that Chicago Cereal is operating is generating 15.9 cents of every dollar of income. So, sorry, let me rephrase that. Chicago Cereal is generating 15.9 cents as income from operations for every dollar that they generate in revenue. Whereas Giant Mills is generating 16.5 cents in income from operations for every dollar that it's generating from revenue. And then net income's the same thing. So we take 1868, subtract 765 to it, we get 1103. 2958 minus 1134 gives you the 1824. We divide the 1103 by the 11776, and that's how they get the 9.4%. Subsequently, you also do the same thing for Giant Mills. So to refresh a little bit, remember that horizontal analysis is performed on the same company, on one company. You're doing just one company. Vertical analysis is performed on two companies when you want to compare two companies. And what we do is reduce it to common size, which is what we just did, so that we compare both companies using apples to apples, just like we just did. Any questions? It's pretty simple, pretty hard, confusing. You don't like the math. What? Well, I know you guys don't like math. Not too bad. Okay, so we've discovered some things about Chicago. Net sales are much less than those of Giant. Vertical analysis, common size analysis, eliminates the impact of these size differences. Chicago has a higher gross profit percentage, so that would mean that their production process is more efficient because it's costing less as a percentage of every dollar generated to produce its product than Giant is to produce its product. As I said, Chicago is only getting 44 cents of every dollar generated in revenue to gross profit. Whereas Giant is getting 35.6 cents for every dollar gross profit. So Chicago is better at operating or producing product. But Chicago's selling administrative expenses are more. So it's spending more in running the operation of the business, the daily operation of the business, and marketing the business. 28.1 cents of every revenue dollar is going to Chicago's selling and administrative expenses, whereas 19.4 cents on every dollar is going to selling and administrative expenses for General Mills, Giant Mills. And Chicago's net income as a percentage of net sales is less than Giant. So Giant is making 10.2 cents of every dollar generated in revenue to net income, to profit. Whereas Chicago is only producing 9.4 cents of profit or net income for every dollar generated in revenue. All right, I'm going to stop there. This is getting into the ratios, which I want to start covering on Friday. Unless anybody has any questions. Okay, if there's no question, I don't see any questions in the chat. I'm going to say have a great day. And thank you for coming.